were making money faster than we could spend it. So it didn't make sense to raise. Once we ultimately did fundraise, it was 5 years later. We were already doing something like $45 or $50 million in revenue. We raised a $50 million growth round. So we skipped the seed, skipped the Series A, skipped all that and went straight to this growth round. And honestly, we didn't even need the capital when we raised that round. But we're also at something like $800 million in annual revenue and profitable. And I was at the IPO in 2021. I was actually invited to go up on the podium and ring the bell with Tim, which was just incredible. I did not expect that.
So in this pod, we don't shy away from taboo topics like money. How did that first wave of money kind of affect you mentally, but also behaviorally, your friends, your family?
We were able to work out something that I think was fair. I left a lot of money on the table because of it, but I haven't regretted it once because...
Hello, Internet. Quick announcement here. We're changing the name of the pod from the Rare Cap Podcast to Delusional Podcast. This episode is a special one because it's a part one of 2-episode series where we're interviewing the 2 different GPs of the same firm. I think it was a cool experiment and I can't wait to show you that. So this first episode, we're interviewing legend number 1, Jake Gibson, who was one of the co-founders and GPs of Better Tomorrow Ventures. He co-founded NerdWallet, which is a publicly listed $1 billion company. He's also a successful angel investor. And then he teamed up with Sheel, who's the second GP of this firm, also a legend, to build Better Tomorrow Ventures. In this episode, we're going to talk about how he walked away from a lot of money to prioritize his family, his learnings on angel investing, and then building Better Tomorrow Ventures as a firm, how he looks at the US market differently than emerging markets, and why he's bullish on Brazil. Without further ado, let's get into the conversation. We're very excited to have Corridor sponsoring this show. If you haven't heard of Corridor, they're one of the fastest growing fintechs in Africa, redefining the payment rails across the continent. As you know, Africa's payment landscape is highly fragmented, and Corridor is here to fix that. They're led by an exceptional founder called Omar Bari. To learn more about Corridor, check the description below or visit their website, corridor.com. We are honored to have Omni Retail sponsoring this podcast. Omni Retail is a fascinating case study on how to build a resilient business model in a seemingly tough space. While many supply chain startups in Africa have had a hard time with unit economics, Omni Retail seem to have cracked the code. They've been thriving over the past years. They're building the largest profitable network of retailers across Africa, simplifying logistics and retailing of essential goods in the continent. To learn more about Omni Retail, check the description below or visit the website omniretail.africa.
Jake, what is up? Thank you for doing this.
Yeah, of course. Thanks for having me.
So for those who don't know you, I say your career is like 3 parts. First, started as a trader / investment banker, and then co-founded NerdWallet. It's a $1 billion company now, publicly listed. And third phase is Better Tomorrow Ventures, the fintech specialist, early stage venture capital fund. Let's start with NerdWallet. For those who don't know it, mostly emerging market people, what is NerdWallet? What does it do? And then what were the very first hypotheses that you had around the idea, and how did you guys start?
Yeah, for sure. So NerdWallet is basically a website to help you find the best financial products. So helping consumers find the right credit card, bank account, brokerage account, shop for insurance, all that stuff. Which nowadays is not a very new and novel idea, but 15 years ago was. And then we just got lucky by the timing. Like when you start a company in like credit products, like credit cards was our first product, right? When you start a company in kind of consumer lending and credit cards at the bottom of the financial crisis, then when the economy recovered and the banking system recovered and people and like Chase and Amex are like in this war for wallet share, we were able to ride that wave out of that as well. So it was like great timing plus, some correct hypotheses around kind of what we wanted to build and why.
Yeah. So you built your first version of the product. You go to the market. What's the feedback?
It's interesting because so if you look at NerdWallet today, it's not really like a product company. It's a marketing company. It's very much a content. We're effectively like a media company. We didn't raise any outside funding. So NerdWallet was kind of famously bootstrapped for a long time. We didn't have any money to spend on advertising. And in the consumer business, like you have to advertise somehow. And so SEO, we figured, was the way that we can just invest a lot of like blood, sweat, and tears and ultimately drive the most traffic long term and not have to like pay for all of that traffic. And that turned out to be right. And it took a few years before Google kind of rewarded us for that and kind of recognized that. But there were a bunch of algorithm changes in 2011 and early 2012 that like really changed the game for us. It like wiped out a lot of our competition. You know, we went from like making no money in the first half of 2011 to like, I think we did like $1.5 million or something by the end of 2011. And mind you, it was like just the two of us, 2.5 people basically at that point. You know, we built this product. We were very proud of it. Just nobody cared. So we had to become a marketing machine. Yeah. And, you know, that's kind of colored how I look at consumer fintech and any kind of tech these days is that distribution far outweighs product 9 times out of 10.
Yeah. And on your decision not to take VC money, why did you want to bootstrap? And then at which point did you feel that, okay, now, you know, we have to do that last push before IPO?
Yeah, for sure. So the short answer is we didn't think we could. Like we were 2 guys that came here from New York, from Wall Street. We didn't really have a Silicon Valley network. We didn't know any of the VCs. We only knew what we kind of read in TechCrunch, right? And so we didn't even know how to get started, really. And that means that we can't spend money on advertising because we're always going to be doing it unprofitably. We're going to be competing with these people that can pay a lot more than we can. And so then what were we going to do with that funding? And at the time, like we were writing all of our own code. You know, we were hiring like cheap contractors to do the design and some of the PR stuff. We were writing all of our own blog posts. We were doing a lot of our own marketing. We kind of just did everything ourselves. And so like we really took the approach of we're going to figure out how to make this business work on our own. And then once we crack that, maybe we'll raise money to continue to invest in that and to grow it. But then what happened was once we started making money, we were making money faster than we could spend it. So it didn't make sense to raise. And once we ultimately did fundraise, it was 5 years later. We were already doing something like $45 or $50 million in revenue. We raised a $50 million growth round. So we skipped the seed, skipped the Series A, skipped all that and went straight to this growth round led by IVP and RRE and some other names like that. And honestly, we didn't even need the capital when we raised that round.
Cool. So you ended up leaving the company, and then the company kept growing until IPO.
Yeah. It was not a straight path. It was very up and down on the way to the IPO, but yeah, for sure. Company's in a great spot now.
Yeah. Can you share some numbers about the scale today, how big it is? And then also like, how do you feel seeing so many people around using something that you initially
No,
created?
it's amazing. And actually funny enough, so I was in Boulder this last weekend at CU and went to a CU football game. And I actually sat in the NerdWallet touchdown club at CU's football stadium. And so, seeing NerdWallet everywhere, like there was a Super Bowl commercial. My son is really into the NBA and he gets to see NerdWallet logos all over the NBA playoffs. So It's amazing to be part of that. And so, I left when my kids were born at this point, almost 12 years ago. And so the company's done a lot more since I left. I think we were, I left before that fundraise. I left like well before the IPO. But the company, Tim did a great job of kind of continuing to go on from there. We went public back in 2021. The scale now, I think the company's technically, the stock bounces around a lot. It's pretty illiquid, so it's volatile. But I think we're at like a $850 million market cap or something right now. But we're also at something like $800 million in annual revenue, and profitable. And so it's just amazing to be able to like say that I was a part of that. And I was at the IPO in 2021. I was actually invited to go up on the podium and ring the bell with Tim, which was just incredible. I did not expect that.
Nice.
So
lovely. Yeah. So in this pod, we don't shy away from taboo topics like money. Was that the first proper liquidity event that you had, or maybe you had it before in your previous career? And how did that first, wave of money kind of affect you mentally, but also behaviorally, your friends, your family?
Yeah, for sure. So Tim and I both worked on Wall Street for like 6 years before, or 5 or 6 years before leaving to do NerdWallet. So the reason that we were able to do this and bootstrap it largely for those first 2 years is because we had savings that we could live off of. So we didn't pay ourselves for something like 2 years. So we did have that. And then when I left NerdWallet, I ended up giving up a lot of my equity in exchange for an agreement that I would be able to get some liquidity that would make it such that I would not have to rush out and find another job as soon as I left. Because the idea was I just had twins and I want to take some time off to think about what I want to do with the rest of my life. And also, it was very important to me to be a present father for my twins. And so I wanted to take some time like off where I was just home, focused primarily on the kids while I kind of worked through what I wanted to do with the rest of my life. And so, you know, Tim was great about that. We were able to work out something that I think was fair. I left a lot of money on the table because of it, but I haven't regretted it once because of the freedom that it gave me to be a meaningful part of my kids' lives in their earliest years. Something that carries through to today. And then I was able to have some liquidity that allowed me to start angel investing. And so you talked about kind of the 3 phases of my career, but there was like an interstitial period between NerdWallet and BTV where I spent almost 5 years just angel investing. And so it's funny, like I basically took all the money I made on Wall Street and invested it in starting NerdWallet. And then I was able to take some chips off the table not long after I left NerdWallet when we did that fundraise a year after I left. And I invested that in startups and venture funds and was able to use that to build a track record so that I could start BTV. And then NerdWallet goes public and I was able to get some more liquidity. And that's basically all being plowed into BTV. So it's kind of one serious step after another of like getting some liquidity and then just investing it in myself for the future.
That's awesome.
Yeah.
So yeah, on the angel investing phase, let's say, okay, you're suddenly liquid. You're like, okay, let me support other companies, but do you actually have a playbook? Do you actually, go meet more senior experienced angel investors and hear from experiences and their learnings and try to apply it? Or do you just improvise? And what kind of evolutions of your angel investing journey happened through the different years?
So my approach to almost everything that I've done in life has largely just been to jump in and figure it out. And then, I read a lot and I try to learn along the way, and I definitely meet people along the way and try to improve along the way. But I've never been one that can like sit down and try to think and plan and strategize and then go execute. And so on the angel investing side of things, it kind of just happened organically. Like at that point, I had some friends, like I had some friends from MIT, from college. I had some people that I'd met since I'd been here in Silicon Valley who were starting companies. And so I originally just started advising them. And it wasn't even like really like formal advisory. I was just like hanging out with them and trying to help out with whatever they had going on. And they found that to be very helpful and very rewarding. I found it to be very rewarding. And so I just kept doing it. And so they would introduce me to their friends who were starting companies. And then they would introduce me to their investors who would then introduce me to other portfolio companies. And so I kind of started building a network that way. And along the way, was able to get some liquidity and started going, okay, well, I'm going to start writing checks into the ones that I like the best. Because that was the thing that people do. It's kind of a Silicon Valley stereotype. Like you build a company, you make some money, and then you go start putting it in other companies. And I also the one strategy I have, which, hindsight 2020, I don't know if I was thinking about it this clearly at the time, but the one strategy I did have was I don't know what I want to do with my future. And so meeting a lot of people and learning a lot of things and throwing a lot of spaghetti at the wall and just trying a lot of things, I think is the best way for me to figure out what feels right. And then when I figure out what feels right, I'll double down and like, that'll be my future. And so angel investing was almost like a forcing function to do that, to like force me to build that network, because I had to go out and source deals, meet founders, meet their friends. I started networking a lot with other VCs and with other angel investors and talking to them about deal flow. And so it just kind of forced me to get in the information flow, to learn a lot about the industry, to learn about different companies and different business models, to learn about how different people viewed the investing world, to learn the strategies of like people who worked at large funds, for people who ran small seed funds, for angel investors, and just to see it all firsthand, and then kind of figure out how I wanted to approach it at the same time. And then it was that process that kind of brought me to Sheel's doorstep. And that's how I met Sheel. I got to working with him. And then it was like working with him that got me to the point where I was like, okay, I kind of like this and I think I can be good at it. And so like, let's do more of this.
Nice.
So then that led to us starting BTV.
Sweet. So yeah, let's get to the next chapter, which is starting BTV with Sheel. Sheel is the one that most of the people know on the internet because of his persona. You don't necessarily look in the very similar in your style, in your personalities. Yeah, how did that dating phase happen? How did you get to know each other? And how did you feel that, yes, this is the person where I can, jump on a 10-year, 20-year journey? Yeah, sure. It's such a hard decision.
It wasn't that hard. So it's funny because you talk about us being complementary. Like we just got feedback from one of our LPs that came into our new fund, where like in some of their diligence notes, it said something about like us being complementary and like Sheel is much more like forward facing and outward looking. And like, I forget exactly what words they use, but they describe me as kind of like the thoughtful operator behind the scenes. And so we started describing it kind of as like party in the front, business in the back. The kind of the differences between me and Sheel, because Sheel is absolutely the one he's out every night. He's like meeting people all the time. He's much more on social media, much bigger following and all that stuff. He's doing all this crazy stuff like getting married in Taco Bell and doing the Zoom Bachelor. And like, he's just the guy, he says yes to everything, does everything. And he's a big personality. Whereas I am much more the one that's like likely to kind of stay behind the scenes, stay at home, work more closely with people like one-on-one, and not so much like out and about. And I'm also like the one of the two of us that's kind of more organized when it comes to like managing the mechanics of the fund and stuff like that. But because of that, it makes us a good team. Mm-hmm. And so I think we learned that from working with each other. So I alluded to, I met him when I was angel investing. I went to go do office hours. So he was starting an accelerator called 500 Fintech. It was part of 500, but he was starting his own fintech fund and his own fintech accelerator. And he wanted to meet the NerdWallet guy. And so I came in to like meet him and meet some of the founders that were in his first cohort and do some office hours with them. And we hit it off pretty quickly. And he wanted me to come in and help him with it. And so I did a bunch of diligence on him. I called a bunch of people because he knows everybody. So if you ever want to do any diligence on Sheel, you can literally just like throw a dart and hit somebody and ask them about him. And so I did that. I like reached out to a bunch of people, and it was unequivocal. Like there was nobody that was like, oh yeah, I know him, he's cool. It was everybody loved him. Every single person I talked to had a story. And still to this day, it's like our inside joke that whenever I meet somebody, they're like, oh, you're Sheel's partner. I know Sheel. I'm like, yeah, I know you do. And I'm only known as like the guy who works with Sheel. And then there's always some crazy backstory for like how they got to meet Sheel. But so like we started working together. I actually just quickly kind of got sucked in and helped him build a team for the accelerator, helped him raise the fund, helped him source companies, helped mentor the companies. And so we ended up working very closely together. It was almost, even though it was like, it was his fund, it started to feel like it was our fund. And we did that very closely together for about 3 years. And for a lot of reasons, we didn't want to stay at 500. We weren't planning on raising another vehicle within 500 and kind of continuing on that path and continuing on the accelerator path. But we had an inkling, a hunch that we wanted to work together and we wanted to do something together. We didn't quite know what that was. We spent a lot of time like interviewing at other VC firms to see if it would make sense for one or both of us to go join as like fintech partners at some other VC fund. None of that really felt right. None of it really worked out anyway. So we're working very closely together while we're also both out kind of evaluating our options. And then through that, ultimately, we're like, none of this is going to be a fit for either one of us. The only thing that really makes sense is for us to work together and go on and build something of our own and just kind of take what we started with 500 Fintech, but just do it bigger and better.
Nice. Okay.
And so then that was the idea for BTV, and we kicked that off in 2019.
Sweet. Before digging into BTV itself, just last question with the relationship with Sheel. With such strong personalities, different ones, yes, there is complementarity, but there's also some areas where there's friction
like each other,
or just you go head to head. So yeah, whenever there is that kind of friction and the tension goes up, how do you guys clear the air?
I'd say there haven't been a lot of things. There's things here and there, like little things where we've kind of opposed each other and had some conflict. But I think like neither one of us takes ourselves that seriously. You know, neither one of us is going to just like, you know, go to the mat fighting about something. If the other person feels super strongly about something, we're quite likely to just let that person kind of give themselves the rope to hang themselves with, right? Like, if you know, if he's really banging the table about something that I don't agree with, then I think ultimately the resolution kind of ends up being, well, if you feel that strongly about it, like maybe there's something I'm missing, go for it, and then we'll reevaluate later and see whether you were right or whether I was right. And then, you know, both of us have pretty low egos when it comes to this sort of stuff. So, you know, I've fucked up plenty of things since we started this fund. He's fucked up things since we started this fund, and neither one of us is hesitant to be like, oh yeah, okay, I fucked up.
Yeah.
And I think that's important to the relationship. Like, you know, we split ownership of this fund 50-50. We intentionally started this fund with like no deal attribution, none of the things that kind of create politics within a venture fund. It's a team effort. It's a collaborative effort. And so we approach everything that way, you know, just keep the ego low. We don't take ourselves too seriously and just, you know, try to do our best work, try to help each other where we can.
Nice. So like looking from an outsider perspective, I would say, okay, NerdWallet co-founder and then angel investor, and on Sheel build businesses, sold businesses, also, you know, partner at 500. You guys starting BTV, we would assume that it would have been easy. Like when you go and try to fundraise, you check all the boxes, ex-operator, all the good stuff, right? So I'm like, yeah, if Sheel and Jake can't fundraise, then who can? But is the reality that, Rosie, was it that simple to raise fund one?
No, not at all. And actually, a lot of people, we were getting so much advice from the market and from LPs and stuff. That's like, you know, you guys should be. So we went out with a $60 million target for our first fund. First fund, 500 fintech was 15 million. We also invested like another 20 or 30 million in SPVs at the same time. And both of us had invested a few $1,000,000 in like angel investing and stuff like that. And so it wasn't like, you know, we had a track record and we already had a record of like incrementally investing more and more dollars. So 60 to us was not a huge jump, but to the rest of the world, it seemed like a kind of an audacious ask. Like we did benefit a lot from the fact that we had a great network of people that could invest in us. Like Wall Street contacts of mine, like former co-founders of ours, like founders that we backed who now had the capital to invest, GPs at other funds. We had an amazing group of GPs from funds like Andreessen and stuff like that backed us in that first fund. And so for our first close, we were actually able to close like close to $20 million, which was huge. But it was all effectively all individuals, and like small family offices and stuff like that we already had relationships with. But then after that, trying to get the institutional investors to commit was very difficult. So we didn't have a single anchor sort of check in fund one. Everything was like a $1 to maybe $5 million commitment. So even when we did get the institutional investors to commit, most of whom are still with us today in fund three, it was like, let's just dip our toe in and test these guys out for a fund with a small allocation, and then we'll think about upsizing later on. So it was pulling teeth for a long time. But then as you can imagine, by May of 2020, everything had changed. Yeah. And we raised that first $30 million or something by May. And then in the next 2 months, we raised $45 million.
Insane.
And it had less to do with us than it did with just the fact that COVID had happened and fintech was hot all of a sudden. And then that made the second fund much easier to raise also because of COVID. But then, you know, we basically used up all of our luck at that point. So by the time we raised fund three, it was an entirely different world. And it took us a year to raise a smaller fund for fund three than we raised in 3 months for fund two.
Makes sense.
So from fund one to fund two, we doubled in size. So we went from 75 million in fund one to 150 million in fund two. And we're at 140 for fund three.
Nice.
So, I mean, we downsized a little bit. We thought we were going to have to downsize a lot more. It was a much harder fundraise.
Yeah, makes sense. And then, most Silicon Valley-based fintech investors would just do US fintech, or maybe US and a little bit of Canada and maybe Europe. In your case, you invest in Brazil, in Saudi, in Nigeria. Do you do this out of your opportunistic pocket without telling LPs, or is emerging market an actual theme and slide in your fundraise?
Yeah, so the way that we think about it is we just want to invest in the best founders who have a unique insight into where financial services is going and are going to go build that hell or high water, right? And so those founders aren't all in America. Again, frankly, most of them probably, like a lot of them aren't. And a lot of the interesting opportunities in fintech and kind of the evolution of financial services is happening outside of the US. Markets like Brazil present really interesting kind of scenarios where you have a massive population of people that are all digitally native, well-educated, increasingly wealthy. Some of these countries, you can't even really think of them as like emerging markets anymore. Like they're big developed economies, but they still have financial industries that are like decades behind ours in terms of maturity, and where access for most of their citizens is kind of out of reach. Like the financial services system in a lot of these countries is really just set up to serve the wealthiest or to serve businesses, whereas most of the economy is individual consumers and small businesses. And so, fintech has a unique opportunity to kind of grow the pie and bring access to a lot more people and to a lot more businesses and all this stuff in a lot of these economies. And that's the kind of stuff that we get excited about.
On Brazil specifically, your investors in Calisa, Divi Bank, Stay, probably other ones. Yeah. Do you want to choose a couple of them and give examples of, who they are, what they do?
Yeah, so I guess two that I'll call out. So Portal is one that you didn't mention, but they're based in Sao Paulo or outside of Sao Paulo, and it's kind of it's an expense management and corporate card company, similar to Brex or Ramp here in the U.S., but on a very different scale. It's an interesting company because they only ever raised a couple $1 million in funding. I think maybe $3 million in equity funding total. They're doing more than $6 million in revenue. They're growing. And so pretty excited about that company. They're profitable. They've been able to just kind of put their heads down and execute. And it's you don't see that in the US, a company that only raises $3 million and can generate that kind of revenue. And another one is Stay. So that's like the earliest stage company that we have in Brazil right now. This was cool because I was an angel investor in Human Interest here in the US. So Human Interest and Guideline, some of these other companies were like, 401ks for SMBs, software to like make it easier to manage and make it more user friendly and all this stuff. And so Stay is basically doing that for Brazil. And now Brazil is very different because they're all on private pensions. It's not 401ks. There's not a 401k construct in Brazil. And the way these private pensions typically work is like a large insurance company selling these pension plans to large employers. And so all the small and mid-sized businesses and their employees don't really get access to any sort of retirement savings. And so most Brazilians just don't have retirement savings. It's not the same culture as it is here, where like the 401k is everywhere. And it's like the number one, outside of health insurance, it's like the number one benefit you offer to your employees, right? And so what they're doing is they're building software to make it more scalable for these large insurance companies to offer these sorts of private pension plans to a lot of small businesses and their employees. And then you manage it all through WhatsApp and stuff like that. And it's cool. And so they're seed stage. So they still have a long way to go, but they're getting a lot of great traction. The product is resonating, and the team is really sharp. So we're excited to watch that one play out.
Nice. So when investing in US fintech and then looking at opportunities in emerging markets, is there some subtle brain switch that you do to be able to look at an emerging market company within the local landscape? How do you have to think about them differently?
Yeah, a little bit. So the way that we try to approach it is like, we're the fintech experts. We've invested in hundreds of companies here in the US. We've seen how business models work or don't work. And so what we try to understand about these other markets is where are those same sorts of opportunities to build similar sorts of businesses, but in a different market with a different regulatory regime, with a different different user base and different culture. And so how much can we kind of get ourselves smart on like what's the same and what's different between the US and there? And are the things that are the same, like, and like the similarities and the differences, do they make the businesses better or worse, basically? And so that's ultimately the framework for us. And then we know that we're never going to be the experts on the local market. So we can bring the fintech expertise to bear to really help these companies and to understand these businesses. But we know there's always going to be like unknown unknowns around the culture or around the marketplace or around the businesses or just little things. Like you can't know everything if you're not there. And so that is just the risk that we take. And we try to mitigate some of that by working with local partners. So like even if we lead the round of a company in Brazil or in Mexico or something like that, we are almost always investing alongside a local fund that knows it better.
Yeah.
And so like we can kind of lean on them a little bit to kind of underwrite some of the things that we're missing out on, and then they can lean on us to underwrite a lot of the fintech stuff. And then, kind of work together to help the founders the best we can that way.
Yeah, makes sense. Okay. As a fintech specialist, like, we had in my previous job, like 100 portfolio companies, and we did everything from banking as a service to card issuance, reconciliation tools, cross-border remittance, treasury management, and everything in between. And at some point, you're like, okay, I pretty much backed every single model that I can think of and that I'm excited about. So yeah, having such large portfolio company and now raising fund 3, how can you do things differently that are not obviously already in your portfolio?
Yeah, I'll tell you that it's less about what's already in our portfolio and more about like, since we've been doing this for 15 years now and been investing for more than 10 years now, you kind of feel like you've seen it all. So we get pitched ideas that have been tried and failed every couple of years for the last 10 years, right? And it happens a lot. And I think there's a lot of people who just don't kind of take that second order thinking of like, why has this problem not been solved yet? This doesn't seem like a particularly complicated idea, so why has nobody really figured it out? And kind of go back and do the research of all the different companies that have tried it and didn't figure it out and why they didn't work. So that's the most challenging thing, is like trying to find those diamonds in the rough where somebody actually has like a unique perspective, a unique background, So one of the good things about financial services is, as is it's dozens of industries, and there's cottage industries within those industries, and it's a global business. So there's a lot of surface area. And so, 100 people are going to come up with ideas for neobanks or for personal finance managers or, high yield savings accounts, or like there's things that are just so surface level that everybody knows. But then some people are going to find some insight into like some unique corner of financial services and where like technology can actually move the needle. And so that's what we're always looking for, is like, who are those people that have that kind of unique idea and that unique perspective? But then also like the world changes every few years. So, COVID created a lot of opportunities that were not around before that. Now AI is creating a lot more opportunities. So naturally, like everything we're looking at now pretty much has an AI angle of some sort. And every company in our portfolio is kind of taking on more and more AI in their day-to-day operations as well. And so that's just creating a different wave of opportunities. And it's kind of been our thesis since we started the fund that's what happens, right? Like in the early days, you have like kind of the surface level innovations. You start to build these abstraction layers, and then you start to build enabling technologies on top of those abstraction layers. And then that compounds. You have enabling technology on top of enabling technology. And over time, like the business models that you can build just become vastly different than what you could have predicted 10 years ago. And so we saw that with the internet. We saw that with mobile. And now you saw that with the cloud. And now we're seeing it in fintech as pieces of financial services infrastructure are being turned into software, modularized, distributed. And then like people are building new interesting things on top of that. And then you can kind of take that and have another layer of creativity on top of that. And so it's changing the sorts of businesses that you can build today versus what would have been possible 10 years ago when we started. And we fully expect that that's just the nature of innovation. Like these waves are going to come and go. New things are going to come and go. And so financial services is not going anywhere. It's a 5,000-year-old industry. Money doesn't go out of style. And so we know that we're still going to be investing in financial services just on a different technology substrate 10 years from now.
Yeah.
So,
yeah. So on debate on fintech, you have the fintech protagonists who say fintech is only 1% built. There's so much more to do. And then the other ones who say, oh, fintech took the spotlight for so many years. It's been overfunded. Enough of fintech. You guys all think the same. the real opportunities elsewhere. So yeah, how do you answer that?
Yeah.
And, do you believe fintech is 1% built?
I do, because I think that the people in that second category are taking a very myopic view of what counts as fintech. So I think what tends to happen when you see a lot of capital rush into fintech and then rush out of fintech is it's the same sorts of business models that are getting funded, and it's the most capital intensive business models. And it tends to be the stuff that we as consumers touch every day because it's the stuff that people think they understand. So it's banking products, it's lending businesses, it's insurance businesses, it's anything that can consume a lot of capital, and it's typically consumer. Because your average investor doesn't actually understand the layers behind the layers behind the layers of financial services. They don't know like the infrastructure of financial services. They don't know how financial markets actually work behind the scenes. They don't know how money moves from here to Brazil behind the scenes. They don't actually know how banks make money. They think that banks make money because consumers pay them, right? And so you make a consumer product and the consumer will pay you and you'll make money. And that's just not how banks work. They don't understand lending businesses or how you have to capitalize a lending business. They don't understand how risk is taken and how risk is like embodied in an insurance business and in an insurance balance sheet and how insurance companies actually make money. And so they tend to fund a lot of the same ideas, and those are also ideas that can absorb a lot of capital. And then those are the first things to die when the capital dries up. And so if that is the only thing that you think about when you think about fintech, then yeah, like it's always going to go through waves. I think there's still plenty of room for innovation on the consumer side in fintech, but I don't think the most exciting things are what's always getting backed.
Yeah.
And then meanwhile, like there's so much intricacy that goes into how money is stored, how money is moved, how risk is sliced and diced, how risk is assumed, how risk is sold, and then how that's different geography by geography around the world. There's just so much complexity to that. And you can kind of fractally kind of look down at different layers of complexity and build businesses at all of those layers. And most of the people just don't see that.
Last question. You just closed Fund 3.
Yep.
In a moment where AI is bring a tectonic shift to the world and to the society and to the economy, and we're all equally clueless about what the world's going to look like in 3-4 years. So how can two clueless people, you and Sheel, pitch other clueless people who are the LPs to give you money about a world that we don't even know what it's going to look like?
Yeah, I mean, I think we pitched them that we're just always going to do what we've done, which is like invest in the best founders, keep our heads down, focus on what we know well, not get distracted by the noise, not get pulled in directions that we don't understand, stay in our strike zone, and just keep doing what we do. And I think LPs like to hear that. And I think ultimately, at the end of the day, none of us know what's going on.
Yeah.
And it's not unique to AI. Nobody knows anything ever. Like we can't predict the future. And so all we could do is just partner with great people and ride their coattails into whatever generational things they end up building. And so AI is just another tool to do that. And it's a very exciting tool to do that. It creates a lot of efficiencies. It creates a lot of productivity. And there's so many more things that we can do now that we couldn't do a few years ago. And we don't even know what all those things are yet. So I just think it's exciting. Like, I just think that our opportunities to invest in generational companies in this next cycle is so much more than it even was in the last cycle, the cycle before.
Nice. Makes sense. Jake, this was refreshing.
Yeah.
Thank you for sitting down with me, and looking forward to continue partnering over the next couple of decades.
Yeah. Likewise, man. Likewise.
Awesome. Cheers.
Right,
Thank you.
Cheers.